Traditional versus Roth IRA. Choosing the right one will leave you with dramatically more money. But if you only look at the tax rates, you might end up with the wrong one. I've passed the CFP exam at 16 and have helped millions improve their finances over the last 8 years, and in 5 minutes, I'll help you pick the right one. An IRA, or individual retirement account, is not an investment. It's a tax-sheltered investment account, and this is true for the Roth and traditional versions. They both share the same basic structure. The government gives you special tax treatment on the money you keep in it, and the only difference is when you pay taxes. With a Roth IRA, you deposit money that's already been taxed, so your normal take-home pay, and it grows completely tax-free. When you retire and pull it out, you don't owe the IRS anything. A traditional IRA flips the tax timing, so you get a tax deduction the year you contribute, which means you're investing pre-tax dollars, but you'll owe tax on every dollar you withdraw in retirement. Understanding this tax treatment of Roth and traditional IRAs is the first step in understanding why one usually beats the other. But there's an equally crucial part that most people overlook. By the way, if this video is helping you, please like and subscribe. It helps more people find practical money management tips like these. The choice between the two accounts comes down to this. For most young earners, the Roth IRA is far better because your income tax rate today is probably the lowest that it'll ever be. So you'll pay tax when your rate is low, and you'll avoid tax later when your rate would be higher. If you invest $200 a month from age 25 to 65 in the stock market, you'll end up with about $1.4 million. And with a Roth IRA, all of this money stays yours without any taxes because you've already paid taxes when you contributed. But with a traditional IRA, that same balance would cost you hundreds of thousands in taxes. While studying for the CFP exam, I learned that retirees routinely get blindsided by exactly this: a 6-figure tax bill on money that they assumed was all theirs. But there's another reason to choose a Roth IRA. A traditional IRA comes with required minimum distributions, or RMDs, which means once you hit 75 years old, the IRS forces you to withdraw a set amount every single year, and of course pay tax on it. A Roth IRA has no RMDs at all, so your money keeps compounding tax-free. Say you reach 75 with $1.4 million in a traditional IRA. Your first forced withdrawal is around $57,000, whether you need the money or not, and you owe tax on all of it. The bigger problem with this is what happens to your Social Security. That $57,000 counts toward the income test that the IRS uses to decide how much of your Social Security check is taxable. If you cross $34,000 as a single filer, then up to 85% of your Social Security payments are taxable. But Roth IRAs have no RMDs, and withdrawals are tax-free anyway, so it has no impact on the tax you'll end up paying on Social Security payments. Yet another benefit of Roth IRAs is that you can withdraw your contributions at any age with zero penalties or taxes. So while it's not ideal, a Roth IRA can be a last resort emergency fund. The one real exception is peak income years. If you're in a higher tax bracket now than you expect to be during retirement, then a traditional IRA makes sense because you'll save tax when your tax rate is high and will be taxed at a lower rate when you withdraw later on. Also, if you earn more than the Roth IRA income limit, you cannot make contributions, so make sure to check if you're eligible. Watch this video to actually start growing the money in your Roth or traditional IRA. It's a complete step-by-step guide for beginner investors like you.